Okay, welcome. This is June 21st, 2022, the first day of summer, I believe, and a couple days after Juneteenth. My name is Roger Royse. I'm a tax and corporate partner with the law firm of Haynes, Boone in the Palo, Alto, California office, heart of Silicon Valley. And we're here at the request of your host, Idea to IPO. And here, of course, to talk to you today about our featured topic, which is Funding 101 for Tech Entrepreneurs. So first of all, I want to thank you all for being here. I want to thank Idea to IPO for giving me this opportunity. And again, thank you everybody who's participating in this. So here's how we're going to do this. I'm going to go ahead and share the slides, share the screen. And this is the one most important time I would like to see a chat from somebody, is for someone to tell me when you can see my first slide. All right, can you see my slide? Can see it. Awesome, awesome. We have liftoff. All right. Funding 101 for Tech Entrepreneurs. So let's get right into it. First of all, as I said, I'm a lawyer. I'm not your lawyer. This is general information. If you need specific legal advice, you need to engage a lawyer. Okay, let's just get that clear right from the start, because as you should know, legal advice is very fact specific, and it's really good that you're here and you're educating yourself and you're learning these things and you're taking the time out to attend presentations like this. Keep in mind, this is really just general information, so you know what questions to ask and what direction in which to go. So Funding 101. Let's go through a few statistics about funding, because we are in a really crazy environment right now. And I'm seeing deals fall apart. I'm seeing deals that have been signed but not yet funded being repriced and revalued. I am seeing investors walking away from deals, and in the real estate world, it's even worse. People are big buyers are walking away from millions and millions of dollars of deposits. I've seen that happen with some of my clients rather than close. So a lot of uncertainty because of inflation, because of what's going on with interest rates, because of what's going on with the economy. So it's a very odd time for funding. But the good news is, it's a startup world, it's its own little ecosystem. And I'm not saying it's not influenced by events around the world and in the economy. I am saying that the concerns are just a little bit different, and that's what we're going to talk about today here. So generally, even in good times, you might consider the fact that you're in a highly risky business. In fact, the source profit from tech says 40% of startups will become profitable. I think that number is way high in my experience. I think it's a lot less than that. And I think a lot of companies can exit without becoming profitable, because profit is not really your major concern when you're in a startup. Let me say that again. Profit is not your biggest concern. We're going to talk more about why that is later. Most startups use personal savings during the development process. A little hesitant to cite QuickBooks for a stat, but they ought to know they do a lot of books. And I believe that number. In fact, I think it's probably higher in my world. Almost every startup is going to get a little bit of personal savings just to get rolling, because the founders have to have a little bit of skin in the game. The numbers here are a little dated, but you get the idea. Startup valuations have been growing since 2018. I will tell you anecdotally that valuations have grown by a lot at all levels. That's about to change. I'll tell you more about that in a minute. But you can see valuations have been going up and up and up. Most of the smaller venture capital funds, according to Top Toll, are located in the US. I think that's changing dramatically as well. We do a whole presentation on fund formation. We'll probably do it in the next 2 months again. And we're seeing a lot more funds being formed outside of the US, and in particular outside of Silicon Valley. Most companies raise 3 rounds of financing before Series A, depending how you define a round of financing. But these days, it's super easy to do a round. You don't need to. 20 years ago, you could have had convertible debt, but you usually priced the round, meaning that you sold an equity instrument like preferred stock, which is an expensive, somewhat time-consuming, laborious process. It's not like that these days. There are some tools and techniques that have been developed that make raising that pre-Series A money a lot easier. We'll talk about that. And here's the really interesting factoid. 0.05% of startups raise venture capital, according to Fundera. However, almost everybody thinks they're going to raise venture capital. It's a lot like American Idol. Everyone thinks they're going to be American Idol, but not many people get there. The takeaway you should have is, even though I'm going to talk a little bit about venture capital today, it might not be where you end up. You might end up with angel financing, super angels, microfinance. You might not get to the VCs. I want to temper that with the fact that 2021 was a big year for venture capital. So that number is probably a little higher. We'll get to that a little later on as well. Again, let me just kind of hit you with the reality check before we get too far into this. But startups are like a big funnel. That's kind of how I think about them. There's like 1 million of them up here at the online do-it-yourself. I'm going to form a company as a hobby that I'm not really serious about stage. Down here to the middle where, yes, I am serious about this and I'm committed and we're going to do things right. And what do you know? We raised a little money. You know, that's maybe 1 in 10 of them in my experience, maybe 1 in 8. And down here to the bottom of the funnel where, yes, we're going to exit and we're all going to get rich because we worked really hard at this. We did everything right. We raised money from the right people. We raised the right amount of money. We went into the right industry, or we pivoted into the right business. We had the right team. We had that perfect storm. And now we're exiting. It's a big funnel. And in that funnel, 9 of 10 don't make it, according to Failure. What a name. You already know what their bias is. But I believe that's right. In fact, honestly, I think it's a little higher. If you count all the companies that never make it to see a lawyer because you can do everything online, it seems, for a long time anyway. 20% fall apart in a year, 30% within 2 years, 50% within 5 years, and 70% within 10 years. I won't argue with the stats, even though my experience has been a little different. Just understand that you're in a super risky business if you're doing this, and your investors know that. And that's going to inform a lot of what the investors expect, right? We'll talk more about that. As we said, this is the American Idol world. Once you get into venture capital financing, you know, half of companies, according to whatever statistic source I forgot to name, expect their next source of funding to be venture, but very few of them actually is. So let's say just a few words about venture capital, and I'm not going to make this whole presentation about venture, but we have to talk about it because I'm in Silicon Valley and that really is a 100-pound gorilla in this space. Here's what I want to say about it that might temper my previous comments about how hard it is to get venture a little bit. Number one, 2020 was a huge year for venture capital. 2020 was biggest year ever, 2020. 2021 was twice 2020. Think about that. I'll give you the numbers in a minute, but we're talking over $600 billion worldwide in 2022. And it was around 300 billion in 2020, and everybody went crazy in 2020. And they said, look how big this is, even given, you know, COVID, et cetera. So go figure, right? There's a tremendous amount of venture in the system. And again, anecdotally, I've seen more venture deals over the past few years than I have historically. So that money has been being spent, right? So I think that 0.05% number has gone up in the last year. US VCs, 330 in the US, in 2021, 330 billion in 17,000 deals. Most of it went to smaller companies. A lot of exits. Again, the exits were via IPO, including SPAC, were about twice what 2020 was. $1 trillion in exits. And when you have a lot of exits, you have people forming new companies and going out and starting the cycle all over again. Valuations are just off the charts, the VC-backed companies. And as of the time I put this slide together, there was a tremendous amount of dry powder. What is dry powder? It means funds that the venture capitalist has raised from their investors that they have not yet invested. And that is still true. I don't know what the number is, but I know it's still a very big number. According to CB Insights, 2021, 621 billion globally, 311 billion in the United States. That's about half of the worldwide venture capital is here in the US. And of that, about a third of that is sitting here in Silicon Valley. Even now, even with most of my clients moving to Austin or Miami or Denver or wherever else, Boise sometimes. So go figure, right? Go figure. And the other interesting thing about 2021 is that the Asia share, I don't know that we have a lot of people from Asia here, but the Asia deal share has gone way up to like a third of the global market, which is really interesting. I don't know what is driving that. But we're here to talk about today, right? So what does 2022 look like? Well, according to Forbes, you can expect fund, I'm going to talk more about why they say this. You can expect that venture funds and their portfolio companies can be expected to hang on to their cash longer. So that dry powder I was talking about, that's the money that the VCs have sitting around either in a bank or in uncalled capital calls from their investors. That's going to hang out there a little bit longer. Can't hang out there forever. And if you've come to our venture capital presentations, you'll understand why. Venture funds have a life, they have a shelf life. They got to invest it or give it back. So you won't expect it to be there forever, but Forbes believes that it's going to hang out a little longer. Valuations are going to come down. I have seen this in my own practice. It is absolutely true. Valuations are coming down. Just expect that. And money will continue to flow out of Silicon Valley, meaning that Silicon Valley venture funds are much more willing to invest outside of the Silicon Valley than they were before. And we've talked a lot about that here. Part of that is because of COVID and because of Zoom and because of all the other online platforms that allow people to communicate across the world with and never meet anybody. So I think that's part of it. The other part of it is the fact that just a lot of talent has become very dispersed around the country and around the world. And according to CNBC, as of not too long ago, they did a big article saying that tech companies that saw a lot of growth during the pandemic, which was really odd, but we saw that, are now trimming costs or cutting jobs or freezing hiring. So just, so, and I know everybody here, you have a different view of the economy, US and worldwide, depending on which news station you watch. But this is the view from where I sit, and this has been absolutely true. Now, I want to tell you about one other metric that is a little concerning to the startup community, and that is the Sequoia memos. Sequoia is a big venture fund right up the road here on Sand Hill Road here in Menlo Park. And I think they're on Sand Hill. Anyway, I know they used to be. Anyhow, in 2008, for the old timers in the audience like me, you might remember this. Do you remember what happened in 2008 in the economy? It was bad. It was very bad, very, very bad. Okay. Right before that hit, Sequoia, the VC, came out with a memo entitled, rest in peace, good times, cautioning their startups that they had better start conserving cash. Don't expect on a lot of follow-on funding from us. Things are going to get bad. it was a real, I still remember the memo really sent a shockwave through the industry. And they called it right. They predicted that last recession, or at least that recession. Okay, so 2020, Sequoia comes out with another memo. Coronavirus, the black swan of 2020. They didn't call it quite as accurately that time. They seem to have misunderstood, I guess, how quickly the economy would bounce back. And frankly, what a huge impact all of that US stimulus money, and not just in the US, but around the world, governments pump money into the local economies, and how long that, I guess, that artificial incentive would keep things afloat. They failed to anticipate the resiliency of the economy. However, just recently, Sequoia has some other advice that recently came out, and you can Google it and you can read about it. CNBC has an article on it, a publication called The Informant, I think actually broke the story. But they've coached startups to cut costs or face a death spiral amid a stock market slump and a bleak economic backdrop. So again, depending on which news channel you watch, because we're in an election year, and people are going to spin things, you're either going to hear that, boy, we got such good job numbers and things are going great, and we have a little adjustment in the stock market that happens once in a while, or you're hearing that things are really, really bad. Well, this is how things are in my neighborhood. The memo counsels companies to preserve cash for survival. It says sustained inflation and conflicts around the world are going to limit the ability for a policy solution. You're not going to see a bunch of stimulus money fix things like the last time around. That's like a one-shot deal, I think. I just don't think governments can afford to do that for long. Just look at the inflation we have now. Anyway, by the way, and even Janet Yellen now has reversed herself and has said, yes, inflation's this is not a temporary thing. It's going to be there for a while. They don't think there's going to be another steep correction followed by a steep recovery, like during the pandemic, right? There's a lot of complex reasons for that are beyond my pay grade, but that's what Sequoia thinks. Here's the interesting fact for you to think about. Here's a quote from the memo. The era of being rewarded for hypergrowth at any cost is quickly coming to an end. And that has always been true in venture and and especially in tech startups. Is the idea is that you show a little bit of, we'll talk more about this, but you show a little traction, you raise some money, almost all that money goes into marketing and sales. Maybe you got to do some development of the product, I don't know, but oftentimes a big part of it, at least, will go into marketing and sales, and boom, you got this big growth. You don't have any net income, but you got revenue growth. And based on that revenue growth, you raise some more money, you do the next round, and you put all that money back into marketing and sales, and boom, you got more revenue growth. The era of being rewarded for that at any cost is coming to an end, according to Sequoia. And maybe the companies go back to fundamentals. And finally, we also have had this thing in the last few years about what they call cheap capital. Interest rates are low. There's been tremendous, not just in venture, but there's been a tremendous amount of money in the system through lots of other sources. The law has become a little more flexible, so angel investors are more able to invest in companies. In other words, government is getting off their backs a little bit more so they can make those investments if they want to. Before, it was much more difficult. Like I said, there was federal money in the system. There's government grants. There was, and this is kind of money that came from other sources, private equity and hedge fund money. But public portfolios have been hit hard, and you just can't count on that going forward, according to the memo. So against that, now I'm going to be a little more positive and kind of let you know what is working. And we'll get into more of the funding basics in a minute, but I'm still wanting to set this up for you. One thing that is working really well, and that every startup company should be incorporating into your story if you can, is ESG. What's ESG? Well, it's what we now call, what we used to call impact investing, philanthropy, sustainable, responsible. Now we call it ESG, environmental social governance. And it is a big deal. And every institutional investor, and by institutional investor, I usually mean VC, every institutional investor really likes to see that in their portfolio. Why is that? Because they're getting pressure from their funds, their investors. And not only that, but the acquirers are getting pressure from the Securities and Exchange Commission, which has come up with proposed rules now, not only on what companies ought to be disclosing, but what venture funds and any other fund for that matter ought to be disclosing if they call themselves ESG. That's a whole other topic. Let's just say it's top of mind, okay, for a lot of reasons. Part of it being SEC mandates, but also just because of what's going on in society in general. So whereas traditional investing is really focused only on how much money can you make me, ESG types of investing has both positive and negative screens, right? So a negative screen is you wouldn't expect to see a lot of, sorry, North Carolina, probably won't expect to see a lot of VCs investing in something, that's related to the tobacco industry, right? Or weapons, for example, especially now, or other, industries that are viewed as negative. I don't know why nuclear is on that. I don't view that as negative. And then there's positive, can you reduce waste? And those companies have been doing really well. I do a lot of work with agriculture tech, and the food waste companies are really coming into their own now. I think there's a big ESG component to that. Similarly, companies that can reduce the carbon footprint of agriculture. Those are, nobody, honestly, I don't know that a lot of people know what that actually is, but a lot of people sure like the sound of it. So we're seeing it, and I hear panels of experts talk about it all the time. And I understand sequestration, but that's about the end of it. Anyway, you can see here, we're not going to go through all these, but you get the idea. The important thing about this, before I leave this topic, is I want to let you know that in ESG, the E is the most important. Environmental is the one that people seem to be much more focused on, right? That's why there's a whole industry around climate tech, and why this has creeped into pretty much every other industry. So keep that in mind. But there's another component to it. There's also the social and governance, and this is coming up in institutional deals as well. Investors are asking to see policies, right? They want to know what your compliance procedures are. How are you ensuring that this is slave labor free, right? And how are you ensuring, this or that, or, the other goal, that you're not using metals from certain countries in your products, etc. The government's part, that's AML, is anti-money laundering and anti-corruption. Investors are wanting to see, especially as the world gets smaller and people do more business around the world, they absolutely need to know that we're not violating, the companies that investors are investing in are not violating any laws, even of their home country, not just US laws. And KYC, know your customer, of course, just what are you company doing to ensure? And this is a simple thing to do. We can just put these procedures in place and then follow them and tick that box. So just keep that in mind as you're building your company for fundraising. Just keep in mind that this is going to come up at some point. And if you've got it baked into your company from the start, then more power to you. By the way, I did an interview a couple weeks ago with John Montgomery from Conscious Capital is what he calls what he does. Anyway, it's the idea that he's been promoting, and a lot of other people as well, but it's a movement that companies not only should have as their main objective the maximizing shareholder wealth, which is how I learned it, and that's traditionally what companies are supposed to do, but also for taking care of other stakeholders, employees, the environment, the community, the society, etc. And in fact, companies that concern themselves with these other factors are going to do well, are going to do better than companies that don't, because they're going to have a better relationship with their customers and the community. And that's the theory. The data has in fact borne that out, has shown that to be true. And that's why I think in the future, you're going to see many more companies formed as flexible purpose or benefit corporations under usually Delaware law. But you're going to see them formed as what we call benefit corporations that have as part of their charter a mandate to concern themselves, or at least the ability to consider other stakeholders other than just maximizing shareholder wealth. So look for that to become more and more of a thing, I think, going forward. All right, the other thing, I'm not going to talk a lot about this, just NFTs, they're just everywhere. I'm seeing just a lot of interest in NFTs, and on that topic, crypto. And here's the other thing that I've seen evolve recently. And we all know what's going on in the stock markets and the crypto markets, et cetera. Okay, I get that. Maybe that's an adjustment. Maybe it's a big adjustment. I don't know. What I do know is that there's still a tremendous amount of interest in this. Lots of funds are involved in this. Some of the largest VCs have billions of dollars in this. Just look at Andreessen is on their third or fourth crypto fund, billions of dollars going into crypto. And by that, I mean, not necessarily in the crypto assets themselves, but in the companies that are working on technologies on the useful and public blockchain projects, and sometimes private blockchain. I will tell you my experience is that these sorts of funds are a little different. They're looking for, if you think about VCs as looking for really big returns, outsized returns, my experience is that the VCs that are, or the funds that are investing more in the tokens themselves are looking for just explosively outsized returns. And I have seen that happen. I could tell you stories that you wouldn't believe about big returns, small funds becoming big funds. And I mean, easily by a factor of 100 and sometimes more. Anyway, they're often structured a little bit different. They look more like a hedge fund sometimes than a typical VC. Their strategy has to be way different because they're not investing in something that, we follow the typical model, where you go to traction, to scale, to market acceptance, to expanding territories, getting new customers, adding new products. Their strategy is you're never going to get to that. Nobody's gotten, well, I can count on one hand a number of companies that have gotten to the end of that sort of, I guess that sort of progression. Instead, it's really more, it looks like they're investing in putting lots of big money into very early stage ideas. In other words, a lot more money goes into ideation and just getting the product out there. So it's a much different strategy than venture, much riskier, but bigger returns. It's just my experience. Again, like whatever that comedian's name was, Dennis somebody, that's just my opinion. I could be wrong. There's a lot of risk in tokens and ICOs that has to be disclosed, of course. And one of the things that's making this a big deal is the platforms. We've had platforms for a while, even in the US, that allow for the trading of tokenized assets, but they're getting way better. They're getting way more sophisticated. They're doing a better job of their own KYC and AML and vetting their own investors. And I think the path to liquidity, if you've got a really good solid token, is just a lot more immediate and easier these days. And that's the other thing that we're seeing. You can now do this in the US a lot more easily than you used to be able to do. Still most of this is going offshore, no doubt, but there is a path in the US. It's a topic for a whole another hour discussion. So I will put a pin on that and move on to investors. Okay, let me pause here, just let people know, those of you who joined late, that yes, we are recording this and you'll get a copy of the recording. Secondly, I am going to send you an email with that copy of the recording and a copy of the slides, as well as some other goodies. And before I sign off here, I will post once again all of my contact information, as well as a link to the YouTube channel or you can view this presentation as recorded plus prior presentations. Okay, let's get into the funding. First of all, some basic principles. Some are basic principles, some are just, I guess, add-ons, but some basic principles to keep in mind, because we sometimes assume people know all this stuff, and then when they don't, we're surprised. So I'm just not going to make that assumption. So that's it. Dennis Miller. Thank you. Thank you, Dennis Miller. It's just my opinion. I might be wrong. All right. You win something for that. I don't know yet what it is. Your investors are your partners. Okay. You know, they're not some third party that you're going to take. They're not a bank, right? You're not going to take money from them and then forget about them until you have to pay them back. They're your partners. They're going to be all over you, right? Depending on who the investor is, for you to perform, for you to keep your promises, for you to do well, for you to keep them in, updated. So keep that in mind. Think of an investor as a partnership, investment as a partnership, and an investor as a partner. Number two concept to keep in mind. Again, this is kind of second nature to a lot of you, what I'm saying, but for some people, they don't quite get it. And here's the scenario, because I have this happen all the time, not all the time, less now than before, but I've had this happen where the startup founder comes in and says, look, I'm not going to spend all of my time raising money. I'm just going to go out with my PPM and I'm going to get $50 million right off the bat. And that'll be enough for the rest of this company's life. We only have to do one round. Okay, two things about that. Number one, no, you're not. You're just not going to. It's not how this game works. And number two, even if you could, you would not want to, right? You would not want to, because you would be giving up way too much of your company at way too early a valuation. If you actually are the kind of company that can raise money, take just enough, stage your financing, take just enough to get you to the next valuation event, right? So take your first $1 million at your $10 million valuation, and take your next $1 million at the $20 million valuation, which the first $1 million got you to. That's the basic concept. And that way you give up less of the company. And that brings me to the third point. Funding is going to be dilutive. Keep that in your mind whenever you take money, even if you don't see it pop up on your cap table immediately, it is going to be dilutive. Those safes and those convertible notes, especially the pre-money safes, you don't really know how much of your company you've given away, but trust me, you have given some of your company away, right? And you really need to understand that. In fact, you should model that. And there are tools out there on the internet that can model. You don't even need internet tools. If you know math, if you've got Excel, you can do what ifs and you can model where you are. And the commercial programs in particular, the commercial cap table management tools, of which there are many, and a few of them that you probably know about, will do that modeling for you as well. So keep that in mind, because you don't want to be surprised down the road when you realize, holy cow, I've got nothing left in my company. I've given it all away in these convertible instruments. Fourth and five are around valuation. And yes, valuation is important, no doubt. It is not your biggest issue sometimes. And and it's not really a measure of what you're worth, not as a company or as a human being, right? It's really a mathematical function based on what your investor expects to happen with this company, how much of the company they need, and how much cash you need. It's oftentimes just that simple, okay? And there are complex models. We talk about them here at ID and IPO that show you valuation, or what investors view as a valuation. But just as a primary matter, think of valuation as just one other negotiating point when you get into term sheets. Avoid early mistakes. I have whole books on this. Early mistakes can tank you later on, or like little time bombs if you don't get things set up correctly early on. Cheap money over expensive money. What do I mean by that? Is that, the trouble with money is that it costs too much, right? And some money comes with bigger strings than other money. Again, this gets into the terms that are attached to the money. The cheapest money you can take is revenue. Boy, if you can get revenue, woohoo, it's even better than grants, because grants you gotta oftentimes have to match. The most expensive money is probably venture capital because they're taking equity. Just understand that. Save your common stock for service providers. Get a data room and start gathering your data. By the way, don't expect me to do that for you. You should do that yourself. That's a librarian's function, not a lawyer's function. It's expensive for me to do it, but you should have a data room and you should be gathering things electronically so that you have it. That's a service we'll offer if requested, but just to make sure that somebody is doing this. And make sure your company is cleaned up and ready to go. You're ready for prime time when you're ready to take money. A lot of people say, look, we're just going to fix this when we have an investor. We'll wait and we'll convert to a corporation when we have an investor, or we'll clean up, we'll get all those invention assignments when we have to. Well, I tell you, some investors are not going to wait, right? They're looking at you, they're looking at your competitors, they want the path of least resistance, so be ready. Is that what the Boy Scouts say? Always be ready or something like that, always be prepared. Sources of funding. Briefly, founders, debt. We're not going to talk about debt. My clients aren't really good candidates for debt for the most part. Government grants. All right, I'm not going to talk a lot about that other than to just a nod and note that it's there. And there's a lot more government money available than people think. And if you qualify for that and have the stomach for doing those applications, God love you, go for it. Friends and family, almost every startup's going to do this. That's why Thanksgivings are so awkward around my place. Angels and seed investors, of course, incubators, pitch competitions, VCs, and then alternative financing. Let's see how much of this we can get through in the remaining time I have. Personal savings and how much to raise. These numbers are a little old, but one time, angels, you could expect around 25 grand each from an angel. I think it's a little higher now. If you're cheap like me, that's about the right number. Angel groups, 250 to 750K. That sounds about right. Early stage VCs, 1.5 million and up. And that's super early. I think it's more like 3 to 5 million for VCs now, even early stage VCs. And then later stage VCs, 10 million and up. That's just the magnitude. You can disagree with me on the exact numbers, but I want to give you the idea of the magnitude. Okay, so here is the funding. This is just, I don't know, this is more lore than law. This is just more of a way to think about it. These are not hard and fast rules, right? It's like Bill Murray said in Ghostbusters when he was approached by, I think, a Sigourney Weaver. He said, look, I have a hard and fast rule about getting involved with possessed people. Of course, it's not really a rule as much as a general principle, more like just a guideline. Well, so these are guidelines. Pre-seed money, that's early, that's idea stage. That's your relative, that's your uncle who's willing to bet on you, and your friends who are willing to take a flyer on this great idea that you've got. All you've got is a PowerPoint. Seed round. That's development of your minimum viable concept, right? You're going to raise the seed money to really build this out and develop the concept. Actually, in my neighborhood, the seed round people want to see a little more traction, to be honest with you. But traditionally, this is how we thought about it. Series A, you definitely have to have traction. The product have better been verified. You better have gotten customers. You better have proven that people will buy this thing, that you can sell one, and you can sell 10 of whatever it is, and you can sell 100, and you've got the support. That's when you take that money for advertising so you can hopefully scale, sell more of them. Now you're at B, you've scaled, your product's large, it's growing. You need financing for additional sales and branding and HR because now you're adding people and support. And finally down to Series C, if you're lucky enough to get that far, now you're getting into new products, you're getting into new markets. That's traditionally how, at least I've thought about it. So your lead investor, even at the angel stage, angel or VC, you're going to have one lead, right? Usually, you might not. You might do what they call a party round where you have a lot of investors. But let's say that you find that one investor that is going to be your, going to beat the drum for you, your Pied Piper, your cowbell, whatever it is. You want that lead because that's the person that's going to be negotiating this transaction with you. That's who you're going to be dealing with. You want that lead to be smart money and not dumb money. What do I mean by that? Right? It's kind of what you would expect. Dumb money doesn't really know what they're getting into. They've given you the money and they disappear, and they don't really have a lot to add. Smart money, on the other hand, they understand your business, they understand your industry, they're sitting on your board, they have insights, they have ideas, they know where things are going, they know who the other players are, who the investment bankers are that you're going to be talking to down the road, and what the future, they have a good vision. Let me put it that way. You'd like your lead to be smart money. You want to get something more than just money. Remember what I said. Venture in particular is really expensive money. You're giving up equity. You want to get more than just money back for that. Is anybody else losing the connection here? Or am I coming through okay for everyone? All right, if you are, chat me if you're losing the connection, just so I know. Okay, we're all good. Well, the recording will be smooth, trust me. Secondly, you want to get along with your investor. You got to have good chemistry. In my book, I talk about examples where there has been good chemistry. I talk about examples where there has not been good chemistry. I talk about an example of somebody where the chemistry was so bad that the founder went online and started writing public, posts about how bad his investor was. You don't want to be that company or that investor. You want good chemistry. You're going to have to live with these people. Commitment. Make sure your lead is committed to your company. There's nothing more frustrating than having an investor that you can't contact, that won't respond, that won't show up at board meetings, that you can't get into signed documents. Okay. Commitment. Deep pockets. You want to know that they've got that dry powder I was talking about, and that, or at least they have access to follow-on investors if it's an angel, right? Deep pockets, more money when you need it, because it sends a good message to the market. If your current investor doubles down and puts more money in, sends a negative message if they don't do that, even if it's because they can't. And finally, good network, right? You want a lead that's got a really good network so they can bring other smart people into your company as investors. Now, I'm not going to talk about debt financing. You're in the wrong place if you qualify for debt financing. Debt financing is a lot cheaper than venture, but as we've talked about here in prior sessions, that implies that you've got cash flow. That implies that you've got some asset that can secure the debt, or that you're willing to give a personal guarantee. None of those apply to your typical high-flying tech startup. If you had cash flow, you wouldn't need venture money. You'd get the cheap debt, right? You don't have cash flow. You don't want cash flow. You're building an asset, not creating short-term cash flow. But if you happen to be the kind of company that does, and there's a lot of you out there that are like this, that do have cash flow, then revenue first and debt second is kind of how I think about it. Debt is way cheaper than selling equity in the long run. Just do the math, way cheaper, right? So consider that. Now, I know interest rates are going up, but and that might affect your calculus a little bit, but generally, selling equity is a really expensive way to raise money. And the reason people do it is because they don't have cash flow or a secured asset that can form the basis of a debt financing. Grant money, just be aware it's there. Everyone should look into it. You might qualify. Oftentimes it has to be matched, so it's not perfect, but it certainly brings your cost of capital way down. Friends and family, outside money, let me kind of jump to that because I think that's what we're mostly interested in here. And by outside, I mean angels, VCs, crowdfunding, private equity, etc. So we touched on this earlier. How much money should your company be raising? Again, stage your financings. Now, the the current thinking, and by current, I mean like today, the current thinking now on how much money it used to be, like even a year ago, even I was saying a year ago, raise enough for a year to 18 months, and you should be able to get to your next valuation metric in that time, whatever it is, tape out, FDA approval, product acceptance, whatever it is, you should be able to get there in a year to 18 months. So raise enough money for that and your valuation will be higher. People are now saying you better plan on a longer time. You better have raise enough money for a longer time, like twice that amount of time. That's what the startup press is saying now. There's that much pessimism in the system. So think about that when you think about how much to raise. You probably want to go out a little bit longer. And congratulations to all the companies that raised money in the first 6 months of this year. On the other hand, I hope you raised enough, right? Because you don't want to run out of money in the middle of a recession. Or you'll be doing down rounds, which will be a topic for another day, which is not the end of the world, but pretty darn close to it. Think about your milestones. What's it going to take? Think about your burn rate. What's the burn rate? Well, that's how fast you're spending all that money. Your runway, what's it take you to get to that milestone? And then finally, the venture capital formula. How much of your company does that VC need? And how much cash do you need? And poof, there's your valuation. There's how much you're going to raise. It's going to enter into your valuation. So think about that. So it's a complex formula and it does require a lot of thought and honestly, a lot of subjectivity. I'm trying to give you rules of thumb, but keep in mind, these are just rules of thumb. Okay, I think we talked about this, stage financings. By the way, your next valuation event, ideally, we would like to see you double your valuation. That's kind of the big valuation bump that back in what is now being called the hypergrowth years, that's what you would expect. That may go down because of what's going on in the market. So that goes into the fact that you probably need a longer runway. The executive summary, everybody should have one of these put together. Now, personally, I think the executive summary should not be a work of art, or a piece of music, or some grand poetry. I think it should be just the facts. I think it should be at a glance, who are you? What are you doing? Why is it important? Just the facts. Do you have IP? Do you have any money? Do you have any revenue these days? What's your competition look like, etc. Just the facts on 1 or 2 pages. And that way you can really cover so much more ground, right? At that point, you're trolling instead of still fishing, because you can have so many more potential investors see who you are and whether you're a good fit than if you have a big fat document or a pitch deck that they have to read the whole thing. You can still have that after you gauge their interest. Start with the executive summary. I'm not going to talk about pitch decks. There are whole presentations and books and so much about pitch decks. I'm going to say just a couple of things. And again, this is just my Dennis Miller-like opinion. I really think you should get a professional designer now, or be really good at it. Let me put it that way. And I know I've heard other people say, don't waste time on design on a pitch deck. And I get that. You want to be frugal. You don't want to show your investor that you're the kind of person that spends money they don't have to. On the other hand, you totally do not want them distracted by how bad the deck looks. And I have had that happen. It's so embarrassing. When you have that meeting with that big top tier VC and their first comment is, you ought to get a designer to do your pitch deck. You don't want them thinking about that. You want them thinking about the team and the product and the industry and how you're going to change the world, not about, how bad your deck looks like. So just make sure it looks good. All right, I'll temper that. Maybe not a professional designer, but make sure it looks good. Secondly, don't put valuation in your pitch deck. That's just the other little tidbit. It sends the wrong signal. It's not going to be respected, first of all. And I've had enough VCs tell me that they really, they discount both the number and the, I guess, the experience and expertise of the people that would be foolish enough to put a number in a pitch deck. That's the most common mistake I see, by the way. Again, I don't want to spend a lot of time on pitch decks or other people that do that. And not only that, we are sort of running to the end of our time. So let me just close. Actually, let's close right here. Let's close with the pitch deck, because the next part of this, maybe we'll do a part 2 to this, because we really didn't get into some of the nuts and bolts of the actual raising. This is more prefatory, so let's close it right here. And what I will say about the pitch deck, let's close on this topic. Mission, obviously, problem to be solved, and how you phrase that problem and your solution can have a lot to do with how successful you are. I think it's one of the big VCs around town likes to say that he wants to invest in aspirin, not vitamins. He wants to know it's a must-have as opposed to a nice to have, I guess. That's another way of saying it. You want to describe the opportunity. Here's another thing. So every once in a while, I'll see a slide that pops up that says, we have no competition, which I don't know, maybe it's true. If that's the case, at least list the alternatives, because it sounds wrong, right? It sounds a little P.T. Barnum to say we have no competition. And you might be in a whole new world, but I would say just make sure that you understand there are alternatives to whatever it is that you're selling, and that's what you're going into. That's what you're competing against. Certainly description about the product and then the business model. And the business model usually requires a lot of thought as well. The VCs are going to focus on that, and the smarter investors will as well. So make sure you pay attention to business model aspects as well. Okay, with that, we're at the top of the hour. I'm going to open it up to questions. If you have questions, go ahead and put it in the Q&A dialog box. Okay, hold on here. Give me a second. Q&A. And by the way, while we're doing that, I'll let you know where you can find copies of this presentation as well as prior ones, even though I'll be emailing them to you. Okay, question number 1. Where is the best place to build a high-tech startup if you need access to financial services partners or any industry that happens to thrive in New York or Silicon Valley? Good question. Okay, so what we've seen over the last few years, more and more, is startups locating. There was a time when, at least I used to say, look, go ahead and locate in Silicon Valley. Every startup ought to be headquartered here. In fact, I tell people, I drive to work, I drive past trillions of dollars of market cap. The biggest tech companies in the world are headquartered here in a fairly small area. Over the last few years, we've seen a migration of companies out of Silicon Valley, but not just because they want to leave here, because they don't like our taxes, our employment laws, our regulatory environment, or our crime rate, or our housing prices, or our traffic. Stop me before I go on and on. But they're leaving because they want to be closer to where their markets are. And this is a really good example. So I don't think New York is maybe a great place as a regulatory matter, but I think it's a great place if you need access to financial services partners. So you might see companies locating there for that reason. It makes perfect sense. You don't have to travel far. You can meet people in the same time zone. You can meet them in person. With respect to your investors, if you're looking for investors in that area, you can have in-person board meetings, which I think are really important. Now, where we really see this is true like I said, is I do a lot of work with agriculture technology. And I've seen many agriculture technology companies start here in Silicon Valley because this is where the tech is, and then end up moving most of their operations to Fargo, or to Iowa or to St. Louis or Chicago, Midwest, where they can be closer to whatever market they serve. Now, a lot of them, of course, stay here because California has a $50 billion a year of ag industry. So their markets are here. But those who service a different segment of the market will actually move to be closer to their customers. And not only that, be closer to the venture investors in those areas that grow up around those markets. So I think it's something to think about, and it's just much more acceptable these days. Okay, my team and I are working on NFT's Web3 project. You talked about the interest of VC and investors in this topic. Can you make examples of the most active VCs in this field? And can you estimate the stage which Web3 projects usually look for money in the VC industry? So a couple of things. Number one, so as I mentioned the Andreessen Fund, but there's so many more. There's probably the most active investors in San Francisco. It's with Paradigm or something like that. Anyway, they're not hiding. In fact, if you Google crypto VCs, you'll pop up with all sorts of lists of the most active and the biggest, and lots of them. And there are lots of them. And the thing to keep in mind is they all have a little bit different focus, so your question, there's a lot of different answers to your question depending on where they're focusing. For example, I know like the first Andreessen Fund, they were really investing in non-blockchain companies that were servicing the industries, like taking investments in companies like Coinbase, for example, the companies that really service those industries. Blockchain Capital, sort of similar. They're investing in public blockchain industry companies. On the other hand, there are several companies that they're more like hedge funds because they're actually investing in the crypto and in the tokens. And as part of that, they want to invest in the companies that are creating the tokens as well. And I put those funds together and I put those deals together, and I've been on both the investor and the company side. And it's just all over the place. It's way different than traditional venture capital, and that everything is just still so early and emerging that I don't think anyone's thinking about. Remember what I said about Series C and beyond? Let's add products and expand our territory. It's kind of not the thinking in this space. Has been my experience. All right. It's more, let's just get out and, prove the market and dominate this particular, whatever our token does, this particular market. It's all just much earlier. It feels like much earlier type investing. The other thing, though, it's much later in that you can get liquidity much more quickly, right? And that is the beauty of tokens. And so that's why they look more like hedge funds, because they might want to just hang on rather than distribute, etc. All right, what is your advice if the investment is from friends, if they come from traditional investment backgrounds, real estate, shops, restaurants? Oh, good question. Yeah, that's a really good question. I'll tell you why. Because like I said, startup investing is really high reward, right? If a startup hits, you're going to hit really big. I mean, we've got so many stories here in Silicon Valley and everywhere else, I'm sure, about, going really big, really fast, hundreds of millions of dollars within months. I've seen that happen over and over. However, the flip side of that is that it is super risky. And I have seen it happen when traditional, base economy industry investors cross over and invest in startups, and they don't quite get that, just how risky what they're doing is, right? And that's the thing they really need to know. And that's why you need to choose your investors really, really carefully. And maybe in part 2 of this presentation, we'll talk more about how to do that, because I talk a lot about that. But you want investors who really understand the risk and are not going to complain if things don't work out, and are not going to sue you if things don't work out because you didn't tell them how risky the investment is. So you want, and unfortunately in startup land, companies do things without a lot of disclosure. That's just the nature of the business. And let's take an aside here. One of the benefits of being old, kind of have theories about why things are the way they are today. But that's a little bit of a fossil, because in the early days, your startup investor was not just anybody with $25,000 in their pocket. It was someone who actually was pretty sophisticated. They did this a lot. They understood the market. They were smart. They had a lot of money. They didn't get all that money by being dumb, right? So, and they were absolutely every time accredited. And accredited means they have more than $1 million in net worth, excluding residents, or have annual income of more than $200,000 a year for the current year and the past 2 years, $300,000 including their spouse. Okay, those are alternative tests. Well, of course, 20 years ago, $1 million was a lot more than it is today. The numbers haven't changed, right? So accredited today means someone who's not as rich as someone 20 years ago. All right. So, but go back 20 years when we used to give hardly any disclosures at all to anybody when they made startup company investments and made hardly any representations. It's because they're accredited. They can take care of themselves. Or not only that, California has a different standard. It's called sophisticated investor. They're also very sophisticated. Well, here we are today where someone can be accredited, but they might not be that bright. Let's be honest. They might not know your industry. They might not understand startup investing. And if you have investors like that, first of all, do you really want them to be on your cap table? And number two, if they are, you better make sure they understand the risk, because the rule in securities law, the rule of thumb, again, more lore than law, but the rule of thumb, the way I like to think about it is that seller beware, right? You've heard buyer beware, and when you're buying products, well, seller beware in securities laws, don't make any mistakes. So yeah, so educate them, be careful. Usually if the investment is from friends, do I have to give them stock similar to an ESOP, or how much should I give them? No, you don't want to sell stock until you're raising more than $1 million. Okay. Let me say that again. You're not going to sell stock until you're raising big money. And here's why. Number one, instead, what you'll do is a convertible instrument. Here on the West Coast, we use an instrument called a SAFE, Simple Agreement for Future Equity. It means you give me the money today, Mr. Investor. I give you the equity later when we have a better idea of what the company's worth and a price that's been negotiated by a professional investor. And we'll get you in at even a discount to that price. So you get rewarded for getting in early. That's the basic concept. And that can be expressed as a convertible note as well. But the basic concept is I get the money today, you get the equity later, and you get to piggyback on the negotiation of a professional investor when we do that. We do that because it's so hard to value a company today. We do that because preferred stock is a hassle. And yes, I know there is watered down Series C preferred, which is a lot easier, but it's still a hassle. Now, you've got people with rights and privileges and rights to vote. And once you go down that rabbit hole of negotiating stock terms, you have to think about voting rights. You have to think about board participation. You have to think about drag-alongs and liquidation preferences, right? And all this stuff. And it's just easier to do this through a convertible. Some people disagree with me on that. They say we can do Series C really easy. I still say don't do it. You're not going to look like every other company out there if you don't do just convertible and then the preferred. Now, I know what some of you are thinking. You're saying, well, wait a minute. What about my ESOPs, right? Employee stock ownership. Actually, I think you mean stock option plan. ESOP is a term of art. It means something different in the US. But you mean your stock options. You mean common stock. I've got common stock I'm giving the founders. Why can't I give that common stock to my investors? Here's what, well, you can, but you should not. And here's why you should not. Your common stock is priced really cheap. It might be worth 1/10 of what your preferred stock is going to be when you finally issue preferred. And you want to keep it that way because you're selling common to service providers, or you're giving them a stock option. And an option is a right to buy common stock in your company at a certain price. That price, at least in the US, has to be fair market value. You want that common stock price to be really cheap. Well, if you sell really cheap stock to an investor, you're giving away a lot of stock, right? On the other hand, if you're selling more expensive preferred stock to an investor for the same money, you're giving away less of your company and you're getting way more bang for your buck, right? So you don't want to sell common stock. First, you want to keep it cheap. That's the other thing. You'll say, well, what if I just raise the price of the common to the investor? So it's priced about like what preferred would be. Well, now your common stock is too high and you can't sell it for cheap to your service providers. So you're getting double whammied there. Number one, you've screwed up the cap table by increasing the price of the common stock to where it's no longer as attractive to service providers. And it's still too low. You're giving too much away to the investor for the same money that they would have gotten if they just had taken a safe. So give them convertibles, not stock, until you do a preferred stock round. And at that point, you'll have very sophisticated people helping you price. Could you please talk some more about how valuations are done? Who does them? What are the components of a valuation? Valuation, where to start? People use that term interchangeably a lot of times. When I say valuation, what I mean is what the investor is going to value your company at. In other words, what percent of your company they're going to need for their money. I don't mean what is sometimes called a 409A valuation, which is a formal study done by a professional to tell you what your common stock is worth so you can grant options. I don't mean an appraisal. I don't mean any sort of formal process where somebody does a study and figures out what your company is worth. We just don't do that in startup land in figuring out how to price stock sold to an investor. Okay, so let's keep that in mind. Now, why that's important primarily is because it's way more art than science, okay? And that's why I keep saying it's not your biggest issue and it's not a reflection on what you're worth. It's a reflection of what's going on in the economy. It's a reflection of what the VC expects, what percentage they want, and how much cash you need. And sometimes in bigger deals, especially in private equity, more sophisticated, more money, more people charging fees, you're going to see people do complex present value analyses, but not for purposes of figuring out how much stock you're going to sell that investor. Now, the exception to the rule is once in a while, the investor will come to you and say, what are you worth? How much are you pricing this at? I see that once in a while. You don't see that with VCs, but you'll see that with other investors. If that happens, then you'll have to apply some techniques. And at that point, you may want to engage a professional to do a valuation to give you credibility. Or you can just run through a bunch of back of the envelope sort of methods and come up with your rough idea of what you think you're worth. And as I discussed in the book, there's a memo attached to this that you'll be getting that really goes through about 30 different ways that I've seen people do their back of the envelope valuations of startup companies that are just too early for a professional to come in and evaluate. How do I feel about entering estimated financials in the pitch? That's fine, okay? In fact, you're gonna want, if you got projections, do the projections. You always see projections, not a problem. By the way, the other thing about projections is you have to be, you can be wildly optimistic about projections. Investors know that, they know that you're kind of pulling those numbers out of the air, that that's what you hope will happen. They understand that, they get that. But you have to be squeaky clean about existing financials. So for example, because startups often make this mistake, you don't book revenue that you haven't earned, right? If someone from big company says, yeah, we might buy 100 units, unless you've got that purchase order, it doesn't go into your revenue number. And even then, maybe not, it's, you got to be just absolutely accurate about that. Why is there such a big distinction? Because the projections, that's really what we call a forward-looking statement, right? That's just, your expectation. That's not a statement of fact. The current financials, that is a statement of fact. You can be sued for fraud for misrepresenting the first one. Second one, you're going to have, if you have well-drafted documents, you'll have disclaimers respecting the forward-looking statements, the financial projections. But yes, you should do that. Absolutely. And I hope that distinction is clear. By the way, we just had a big trial here last year, the Theranos case. In fact, part of it is still going on. And there's a lot of discussion there about securities fraud and about what startups can tell their investors and what what the difference is between being wildly optimistic, like these founders were, or actually allegedly misrepresenting existing fact. Pay attention to that case, and pay attention to what the difference is. It has huge significance in the securities law world. Most investors I've spoken to seem to be obsessed with new technologies. Ain't we all? AI and related buzzwords. Well, these are exciting, but seem to be not too excited about traditional products with innovation. Any thoughts of making such startup product more attractive? Well, I'm not the product guy, but one thing I will say is reading the memos, reading the press, I think we are sort of returning to fundamentals. Remember, even a Sequoia memo mentioned the word hypergrowth, right? Marketing hypergrowth. And I've heard other investors express this sentiment. They want to go back to fundamentals, not magic or smoke and mirrors. So yeah, I know what you mean about buzzwords. I've seen this my whole career, starting, this dates me, but I mean, not starting with buggy whips, but starting with the internet and everybody adding .com to their company. We're no longer Parrot Food Company, we're parrotfood.com. And getting a lot of bump out of that. And then of course we had the dot bombs, the crash, and then I spent a lot of my time changing those names back legally, taking the .com off because I was viewed as not necessarily a positive thing. We may be going through that kind of fundamental shift now because, like you say, a lot of companies are adding something about data, onto what they're doing to make themselves seem more attractive, or something else. I think you talked about AI and related buzzwords. Yeah, that only gets you so far. With smart investors, I think they're going to drill down and understand, that you really do have good basics, good fundamentals, and I think you're going to see more of that. Ooh, how to not pollute your IP by sharing too much technical information with a potential investor. NFT can answer this need, provide a platform that does not need knowledge of coding to produce them. I'm seeking partners to build an ICO for a tokenized coin. Okay, let me take the part of that I can answer about sharing information with a potential investor. You shouldn't ask a venture capitalist for an NDA, at least not until you're in due diligence and they've committed to make an investment. You sometimes can ask angels for NDAs, depending on who the angel is. But for the most part, if they're sophisticated and if they're smart, they won't sign them, because professional investors see way too many companies doing the same thing. I think it's bad here, just going to other industries. Down in Hollywood, you try to ask a studio for an NDA, they'll throw you out. In fact, they make you sign a non-NDA that basically says, you're not going to come after them on allegation at the idea you pitched them, they picked up and just found, a different actor to play or whatever. So it's even worse in other industries. So people shouldn't get so excited about that in the tech startup world, but sometimes people do. But yeah, sophisticated investors won't sign those, at least not until you're in due diligence. So what do you do? What do you do to protect yourself? I don't know about this NFT solution that you're suggesting, maybe, but I can tell you that in terms of investment, what you do to protect yourself is you be careful about what you disclose, number one, right? Just be careful about it, because once you disclose it without an NDA, you might lose your trade secret protection. So you don't want to do that for anybody. And number two, you be careful about who you choose to be your investor, right? Deal with reputable people. We have another program on this. Maybe we'll do a part two where I talk a lot about that. Be careful who you deal with, right? Because this might sound like an odd thing for a lawyer to say, but all the paper in the world cannot protect you from unscrupulous people. Let's keep that in mind. So those are the two things. But think about that, take that seriously. If you disclose something without an NDA, as you're going to be routinely requested to do in this valley, you could lose your trade secret protection because you haven't taken steps to protect it. By the way, if you have questions, put them in the Q&A box, not in the chat, because I won't have a chance to get back to the chat today. Alrighty, what are the things to watch out for in case of strategic investment from a major customer prior to a price round? Good question. We haven't even talked about strategic. Strategic investment differs from financial investors. Financial investor is a venture capitalist. They're there because they want a financial return. A strategic investor means that it's somebody in your industry. They're investing in your company for something more than just a return. Source of supply, you're a potential acquisition target, maybe you get a license, etc. Whatever it is you're looking for beyond just a return. That's a strategic investor, okay? Doing a deal with them, even if it's the same security, preferred stock, is going to look a lot different than doing a deal, in some ways, than doing a deal with a financial investor. It'll look different in a couple of important respects. The number one thing that we usually see that's different is that they're going to want to have some right to be involved in your business down the road. A right to acquire you, a right of first refusal, a right of first offer, a right of first look, something like that. In our other presentation on venture capital terms, I go through what those mean. But you want to be careful that you don't give your strategic investor so many rights to acquire your business that effectively nobody else can, right? Or nobody else will go to the trouble of even finding out if they can, because you have a strategic that's going to take you. That is going to depress the value of your company on exit. That's the number one thing as a legal matter I look out for. Second thing is and I've done this many times, so I can tell you from experience, when you have a strategic, that means a big bureaucratic corporation. And it means that you're dealing with somebody there who might not be there tomorrow. And then you're dealing with somebody else who may or may not be your champion. And if you're not, that follow-on investment just goes away that you were hoping for. Not only that, they might become uncooperative. Don't show up at board meetings. They won't sign anything. They won't read anything. They won't respond to emails. You're Joe's project, not my project. I don't care. So that's something to keep in mind and something to try to anticipate and care for in your documents, because it happens so often. So those are kind of the two really big things that I find. I just find strategics to be less involved in management than venture capitalists are. And I don't know, that's just my experience. Okay. Your mileage could vary. All right. We have 1 minute left. I'm going to answer one last question here, which is how important are patents to VCs? It depends on the VC. Okay. It really does. I'll tell you, as a lawyer, they're really important to me. I think patents add value. I think patents are good. I think you should patent early and often. I think that if you don't have a patent, you don't have a guarantee that you can keep people out of your industry, right? You don't have a monopoly, and a monopoly is a great thing. That's what a patent gives you. It gives you a little bitty monopoly over some aspect. So I think they are important, and people are going to want to see that. And some, it's more important to some than others. I've been in meetings where it's one of the first questions, do you have patents? I've been in other meetings where I've come in promoting the patents of my client, and the VC says, I don't want to invest in a patent, So let's just say it's important, but it's not the most important thing. It's not the end all be all. And you might be in a business where trade secret is more important than patent. So with that, I just want to tell you that that's a great lead in to one of the next presentations we're going to give, which is on top legal issues and top legal mistakes that startup companies make. And I talk a lot about the difference between patent protection and non-patent trade secret protection. So with that, I want to thank you for being here. My name is Roger Royse. I'm a tax and corporate partner with the law firm of Haynes, Boone. I'm based in Palo Alto, California. I work in the Emerging Growth and Venture Capital Group. This has been a presentation by ID to IPO, and we will see you next time.